Today's today I think most of you or everyone wants to know how to raise funds. Or I'm not audible. Am I audible now? Okay, wait. I'll just. Is it audible now? Okay, so for all of you that have gathered here, I think a lot of you are doing your own business, and everyone has a question given the market condition as to how do we raise funds. Ideally, the topic today that we are discussing is identifying and backing India's next unicorn. But if you honestly ask me, everyone in the crowd, for them the topic is how to understand the psychology of a VC. So we have three young investment professionals here with an average experience of 5 years each, having potentially identified a few couple of unicorns in their own portfolio. I have Mr. Anubhav Goyal with me from Chiratae. He has 4 years of experience with Chiratae itself, and he has identified a few unicorns. I'm very happy to say the first name could be Expand My Business, which I am representing. Besides this, he was part of the investment discussions for Bizongo, Claims Buddy, and his expertise is B2B, consumer tech space, health tech space, and SaaS. So all of you, even after the session, if you want to soundboard with him or just introduce your business to him, feel free to do that. Next, I have Mr. Akash Khandelwal, representing Tanglin Ventures. He has 2+ years of experience with Tanglin, with a background in consulting from Dalberg, and he was a founder himself, so somebody who understands the pain that each startup goes through while raising fund, building business, and scaling. Again, one of the few companies he identified as unicorns was EMB, luckily, Pepper Content, and PingSafe, which is in cyber security space. And last but not the least, I have Nivedit, representing Matrix Partners. Very early in his career as far as investment goes, but identified a couple of companies that he thinks are going to be unicorn, which is Woods, which is in light engineering equipment space, and Circla. Yes, the panel has started. Both the names are a bit of a tongue twister for me, but I hope I've got them right. So guys, we'll try to understand the psychology of how top VCs think. We are going to keep it short and simple. It will be a 15 minutes discussion. I'll open up the flow for questions and answers towards the last 5 minutes for all of you. So Anubhav, I'll start with you. Everyone in the room, given the market condition, is asking a pertinent question. What is it that VCs are looking for far as our startup goes? And I know it's a generic question. There could be different metrics if we look objectively from a B2B or B2C standpoint. But in your experience, given the market condition, what do you look for in a startup, and how do you potentially identify a unicorn in the current market condition?
Sure. Thanks, Anant. I think, especially talking about early stage, which is the area that we spend time in, I think the typical journey is from a pre-series A to a pre-seed to a series A kind of a journey. And typically at very early pre-seed stages, you look at a founder because that's just what they are, and they're early to start, and you kind of have to not only look at their experience but probably the intent on why they are building it and what are the key insights that is driving that decision, right? Of course, there's always good if there is a long-term vision to it. It might change as you learn more, but it's always good to have some goal in mind towards which you are going forward with. And as you move beyond to a seed level, I think the expectation of an investor is to spend some time on the product, look at what is the team that has put together, have they put together an MVP in place, and there's some learnings from there. And at a series A level, right, wherein you are writing meaningful checks, the market becomes an important point, right? There is a team in place, they have built out an early product. Is there a market for this wherein this can be a good opportunity for a VC? So I think that's the brief framework that we look at in the early stage when you're looking at a startup.
So before we move on, I'm just curious to know, like, if you compare it to a couple of years back, would you say that maybe with a great team and a great idea, pre-seed stage raising funds would have been easier, and now VCs are looking for a little bit of traction and product market fit before they are taking that conscious decision, or has it not changed?
No, absolutely. There has been a change. I think investing in particular is prone to cycles, right? And when there is a lot of capital in the market, you have more investors and more dry powder. There's naturally, an intent to get in early and back founders, even when probably a lot of things are yet to be are unknown. And I think right now where the markets are, I think typically investors are expecting a lot more. They're seeing what else is the founder learning, or what else can they wait and watch, right? So there's slightly more of a patient game that they are playing. But I think, as founders, I think that's something that one does not need to worry about. You just need to keep on building, and the right investors will definitely land up if you're doing a good job.
Gosh, your thoughts?
Hi everyone, pleasure to be here. Anubhav has covered already most of the things that any of us look when we are investing. Of course, it depends a lot on the stage that you are investing in. I would just like to add a couple of more things on the market. What are the typical characteristics of a great market that a VC looks for? I think one common knowledge is, of course, how big is the TAM? By TAM, I mean total addressable market. How big is the market are you operating in? Is it like $1 billion market? Is it a $10 billion market? Or is it a $100 million market? Because many of the companies that we see scale to a certain level and then they saturate because the market itself is not that big to accommodate $1 billion outcome, right? So that's one thing about the market. The other, and there are of course many other things, but one more thing that I particularly look for in a market is why is it a great time to build in this market right now? And see, all innovation happen in waves, right? Barring a few exceptions. So today, if I say EV is picking up really, really fast in India, right? So it is a great time to build in the EV market, for example. Just EV is an example, right? 5 years ago, an entrepreneur building in the EV market will face so many more challenges compared to an entrepreneur building today, because there is a demand, there is a policy support, VCs, there is investment flowing into the sector. So the things become much easier if the timing in the market is right. And we were discussing this before coming here, like most founders either are too early in their market or too late. But the timing the market right becomes very, very crucial, and it's an art and not the science, and I would not claim that we have cracked it, but that's one thing that I look for, and I usually ask founders, why do you think today is the best time to build in your space? Yeah.
Thank you guys for having me here. I'll touch upon maybe one thing that has become increasingly popular in this capital constrained market, and that is the unit economics. I think that's something that VCs really didn't look at a couple of years ago to some extent. In a rising interest rate market, capital is always constrained, and if you compare it to 2001, 2022, raising capital is not as easy, and hence growth is a little more constrained. So when we invest, we're looking for a founder who has a strong sense of unit economics, a path to profitability, because we know that maybe raising the next round will be a little bit harder. So having a little bit of positive contribution margin, or maybe even PAT profitability, goes a long way in having a longer runway. That's I think increasingly becoming a core area of our focus. I'll just touch upon a little bit more to what Anubhav said. So in a very, very early company, I think as an investor, you have limited data points to make your decision on. So you over-index on the founder. And when you do that, you're looking for maybe a track record of achievement or track record of execution, because these are the only things that can really point to the success of a company when you're writing a pre-seed or a seed check. And it's very difficult to kind of compress maybe 24 or 25 or 26 years of someone's life into 15 or 20 hours of evaluation and have all those data points to do it. So you typically focus on references and where they worked and the kind of work that they did. So these are some kind of things that become very, very important.
Fair enough. I think it's a perfect segue into the next question, which is around many people approach us and ask us, because we have reached a certain stage, like people do reach out to us for advice, and they are always looking out for identifying problems in the right sectors, because just because a founder comes from a certain background, many a time they feel that टैम अच्छा नहीं है मार्केट का, या फिर मे बी राइट टाइमिंग नहीं है, एज यू वर सेइंग. So what sectors, according to you in India, given the current market situation, are few of the sectors which attract you as VCs, where you think you can potentially get more unicorns? So if you have anything specific in mind that you would like to share with the audience.
I'll go first.
Yeah, sure.
So I think the three of us work in very, very different sectors. So we'll be able to provide a very holistic view and probably a very unique view as to what's happening and where people can create companies today. So I've been spending a lot of time on deep tech over the last 6 or 7 months, and we've come to realize that there is a huge opportunity in manufacturing semiconductor chips in India. So fabulous design companies that are designing chips for AI or analog or mixed signal applications. There's a huge market, and we have the opportunity to create possibly the next NVIDIA that's coming out of India. And there's one, I think, primary reason that's driving this. No chip in India today is made without, no chip in the world today is made without an Indian engineer touching it. So we have, I think, approximately 40% of the world's design engineers for electronics in this country. So we expect something to come out over the next maybe couple of years.
So one thing that we as a fund are very excited about is the growing consumption class of India. The top 20, 30 percentile who have just suddenly found, not suddenly found, but have seen their disposable income increasing multifold. And that opens up a lot of opportunities for D2C brands to come and sell, find the right audience and sell to them. So 10 years ago, maybe the disposable income was not there, but if we are becoming a 5 trillion economy in the next 5-7 years, there is going to be a lot of consumption, and a lot of consumption will come from the top 20 percentile income bracket, and that's one of the areas that we are quite excited about.
So I think while we are discussing, which sectors are interesting or which sectors are hot, I think as founders, I strongly believe that if you, are interested in a particular problem, or you feel that this is something that you really want to build for the next 10, 15 years, I think you should build it out irrespective of whether that sector is in the right shape or form, right? You never are at the right place at the right time. You kind of have to drive that serendipity with your hard work. That being said, I think B2B is an area of kind of opportunity which is really interesting. While the last 10 years have been about, consumers getting online and e-commerce being a very strong kind of global driver for, or Indian driver for Indian startups, I think the opportunity in B2B is very large. B2B commerce in India has largely been very fragmented and not digitally enabled. And if there are startups building in that space who are kind of driving in more efficiencies, reducing the loss of productivity, that can be driven by more credit financing in a space which is in a country like India, we are very credit, we're not enough supply in terms of credit. If you're able to help with discovery, right, of suppliers to vendors and enterprises, as well as now talking about the China plus one opportunity, right? If you're also able to enable a cross-border trade, I think those are opportunities which kind of fit in very well with what India's macros are expected to kind of grow to in the next few years.
Just curious, because 4 years back in India, every founder wanted to do B2C, and now the sentiments are like flipping. Is a primary reason that given the market situation, the path to monetization or monetizing your TG is easier in B2B, or any other specific reason also? Because I don't see today that in consumer tech, especially, we feel that there is a certain level of saturation when it comes to e-commerce transaction in the B2C segue. And I'm not just telling in the ambit of companies similar to Flipkart or Amazon, but in general in B2C e-commerce space, I see that people have this belief, at least in the VCs, that path to monetization or profitability is a far cry compared to something in B2B, where there's a tangible monetization clear even within few months of launch of the product. So is that the reason why the sentiments are drifting more towards finding the next set of unicorns in B2B space, or any other reason as well?
I don't think it's the lack of profitability in B2C. I think to credit B2C entrepreneurs, I think they've really done really well. They've kind of built out at a time where penetration of internet in India was very low. And while it was growing, I think it's still not reached, saturation, right? And so I think a lot of growth stage startups in consumer are now becoming profitable, or are building in those small innovations, which is driving that profitability day in and day out, right? So I think it took some time, but it's also a function of the fact that the ecosystem was maturing. I think what drives the interest in B2B more these days is, one is that B2C founders have done a very big, good job in solving for key problems, right? So the easy opportunities which were there have kind of been solved for the first wave. Whereas if you look at B2B, I think that's a market which got digitally transformed only during COVID, right? If you look at startups in our own portfolio, like a Bizongo or XMyB, right? The driver that COVID was a big one, because it brought a lot of businesses online who wanted to kind of transact digitally and make sure that they're part of the new value chain, wherein technology plays a very important role. And I think that is what is driving that interest in B2B.
Okay, so to all of you, lot of people reached out to us and they had this question around, the market is a little confusing right now. Confusing in the sense, people, if you look at startups 2 years back, 3 years back, they were very, at the early stages, they were more focused on growth. They wanted to show a trajectory. And now it's like they are crisscross in their mind. They're like, everyone is talking about profitability, but for early stage startup with no branding, less customers knowing them, where they can get a lot of organic traffic, how do they balance it out, or what is it that is in the psychology of a VC as to what are the key metrics to focus? So maybe we can take B2B for example, and what would you say to those founders in the early stage? How do they strike a balance, or does it kill their chances if they are very profitable business and there's not a, you can say, growth trajectory that they wanted to show, had they not had the extra constraint of profitability given the market condition? So how are you guys thinking, or is it just a misconception that is out there and you guys were always thinking the same before or after funding winter?
Right. So I think when it comes to profitability, there are two things, right? One is, are you making profits at a transaction level? And are you making profits at a company level? Frankly, I don't think any VC in India, especially at seed stage or Series A stage, cares about whether you are profitable at a company level. Maybe, of course, there are more nuances, but profitability is not the key criteria. But what VCs definitely look for is, are you making money on each transaction? For example, if your cost to acquire a customer is 100 rupees, and the customer is only coming to you once or twice, and you're making 20 rupees on each transaction, then you're never going to recover your money from that particular customer, right? So at a unit level, which we call unit economics, right, you're not making money. So those business models, I think, are difficult in this environment from a fundraising perspective. But otherwise, profitability at a company level is not expected. And to summarize, profitability or at least a clear path to profitability at a transaction level, that I think is very, very crucial.
I'll just add this. If you look at the companies that emerged after the dot-com bubble, right? The best companies are formed at the bottom of the cycle. So which is where we are at now, because the grit and determination that a company that started now will have in a capital constrained environment, where you have to maximize your runway and really work hard to prove yourself. That's where the best companies are made. And I think history has shown that time and again. So I wouldn't be concerned about the timing of where the market is. I think you start and prove yourself, and everything else good will follow.
Anubhav, do you want to add something?
I think just a slightly different point. I think what I feel is that I think there are 2 points to it. One, I think it should be an independent founder's call as well, right? Sometimes if you feel your strength is the fact that you can raise capital, right? That's something that naturally, because of your market segment or your team's ability to raise capital is natural to it, you can probably leverage that and try to grow at a growth rate which is better than probably your peers, your competitors, or slightly higher than the rate at which the typical market grows. Whereas, if you feel that, you are in a sector where profitability is very important, right? Or that's something that is key to, how the market values you or peers in the market, then I think focusing on that becomes very important. So I think there is a lot of nuances to it, which I think one should spend time on rather than going through or worrying about waves saying, okay, let's turn the tap on growth and then suddenly turn the tap on profitability, because that's not how startups operate, right? There's always time you take when you're taking certain turns, and you should kind of operate in the best, thinking at what your company best fits in the market that you are in.
Got it. We had a couple of questions to cover, but I'd choose one out of the two. As young investment professionals, you're always taking this leap of faith with startups, and no matter how much you beat about the bush, do data analysis, there is a risk that you're taking. So as investment professionals, how do you mitigate risk while investing or taking those decisions? Do you have a framework in mind, or it's just like you do a coin toss and decide?
See, I think, we operate in an asset class which is very high risk, high return, right? So risk is very natural, right? In fact, we always discuss that, if in an investment decision, right, if there is a very strong consensus, then maybe we are not thinking large enough, right? Or we are not thinking risky enough. So I think risk is an important part to it. I think there are two ways of thinking about it. One is, are you thinking through the risks while you are taking the decision, or are you not being cognizant about them? And the second aspect is, a lot of risk mitigation happens once you are done with the investment, right? Are you spending time with the founder in making sure that he identifies that these are the risks, and probably using your experience as a VC, right, wherein it can be your portfolio companies or your network, are you able to probably add some bit of understanding or help in saying that as we grow, how can we mitigate each of these risks? So I think when you are building for long term and we're building targeting to large businesses, I think risk is very natural. I think you should probably embrace it and not worry too much about it, I think.
Yeah, nothing new to add here. It's an asset class which rewards risk taking, and same for founders, right? If there is no risk, there is no reward. So the business model itself takes care of it, right? We are not investing in one or two companies, but we invest in a portfolio. So that's probably the antidote to the risk. You invest in 20 companies, there is high risk, there is high mortality, but some players really become big, and that's I don't know anything else to add to that. But I think second point is important. We also try to work very closely with the founders so that some of the operational risk are mitigated, identifying the right opportunities, cash flow problems, and so on. I think that is just one way post-investment that VCs try to counter the risk.
I think as a business model, the business model itself caps a risk because there is a limit to the investment size, right? VCs typically put in smaller checks, which forms like a smaller percentage of the overall fund. So you cap risk from the business model itself. That being said, I think at least when we look at companies during our diligence process, we have a rule of thumb internally where we take one leap of faith. So if we are willing to underwrite one large risk in the company, but beyond that, then it becomes very difficult to kind of make the investment.
Summing it up for the audience, I think for me at least, as a moderator of this panel, I felt like there were three strong takeaways. One was related to timing being the biggest factor besides TAM. B2B being an exciting space nowadays as far as investors' mind is concerned. And third thing is that what you said, which is a little bit like on the softer side, that a founder, if he has conviction in a space, he really shouldn't think about the sector and build it. And I think the notion that it's funding winter and all is not right. Maybe the market situation has put founders to put their energies towards ideas that are more scalable, more more sustainable in the long run, and therefore it is the right time to raise fund for right ideas. So guys, I'll open it up to the floor to take a couple of questions with the panel. Mike, please.
Hello. Yeah. Hey everyone. I actually have two questions around the same lines.
Closer.
Better?
Yeah.
Yeah. So one thing I want to ask that operations first businesses, which are not product first or tech first and are in operations heavy, they are somewhat considered not VC backable. One, I want to understand why. And same thing in the health tech sector as well. The products which take a lot of R&D, which take a lot of capital in the R&D, why are they not usually backed by VCs?
So I think the notion that operations heavy businesses are not VC backable, I think is not correct. I think what's important to understand is that VC asset class also has a certain life cycle, right, of returning capital, right? And so as long as technology is being leveraged to kind of use that as a leverage to improve your operations, I think that's definitely backable, right? Just to look at some of the portfolios in our portfolio, some of the companies in our portfolio, something like a Lenskart or a First Cry are very operationally heavy businesses, right? They have operate stores, they also have an e-commerce platform, but there is always a focus on using technology somewhere or the other, right? So that you improve what you're operating as. And if you're doing that, then I think definitely it's something of an opportunity which is scalable and hence backable by a VC.
I'll address the R&D heavy part. So with R&D heavy startups, right, it's almost that it takes almost 18 to 24 months for your product to really develop, and then your monetization starts from there. The 2 years over there is where you have, as an investor, you have zero visibility on anything happening. So it's a thing that makes investors in general very uncomfortable, right? Because you're looking for early traction, you're looking for early data points of success, and 2 years is a long time to wait before the company can really start monetizing the product. That being said, we are also seeing of late that seems to be changing, right? With B2B commerce and e-commerce, India has essentially built out the pipes or the plumbing of distribution for the country. And what has to follow is the IP that's really used in factories and other industries. So we're seeing an increasing number of R&D heavy companies, whether that's in climate tech or semiconductors or electric vehicles also for that matter, that people are more comfortable backing. So that will change. So that perception will go away very soon.
Got it. Thank you.
Guys, last question please, and then we'll wrap it up.
Legendary Warren Buffett said, is keep it simple, silly. So how you keep it simple when we are going to invest in terms of taking risk?
Could you repeat the question, please?
Legendary investor Warren Buffett said, is keep it simple, silly when we are going to do investment. So how you keep simple while we are going to take risk in investment?
Just to repeat the question, like he says that the famous investor Warren Buffett says, to make investment you have to keep it simple. How do you guys keep it simple while making investment?
I think, like I said earlier, when we are making an investment, we are willing to take one leap of faith, right? So one large risk is what we're taking, and beyond that, it's difficult to do an investment, and it's a very simple thing that applies across sectors and across different stages of investments for us. So that's the way we keep it simple.
Yeah, just one last line to add to this. A lot of early stage investing is about the founder. So if you like the founder, we try to ignore some other things which might be more risky. So relying on the founder, we keep the investing simpler.
Thank you everybody, that will be all. And if you want to interact with the investors, they would hang around for a while. If you see them, you bump into them, you can pitch with your ideas, and I hope you find some funds. Thank you guys, have a nice evening.